Hello and welcome to Fund Screener. Our hope is to provide the most intensive fund and ETF research on YouTube, specifically for UK investors. If you enjoy this video, please like and subscribe. All information contained is available in the show notes, which are free to download from the link in the description. If you have any questions, drop them below and they will be answered. Thank you, and let's begin. This is not financial advice. An allocation to emerging markets has become popular among many investors since the term was popularised and specialised products started to roll out in the early 2000s. There are a dizzying array of mutual funds, investment trusts and ETFs available to UK investors, which track various regions, indices and factors in emerging markets. This video seeks to pass through the jargon and give you our top picks for 2021. As an ETF investor, the two standout reasons one may consider investing in emerging markets are growth potential and valuations and diversification benefit. Emerging market economies account for 80% of the global population. Technological advances have and will continue to expedite the industrialization of emerging economies. This enhances the real potential for individuals in the developing world to match the income and consumption capacities of those in the developed world. Rates of urbanization and real GDP per capita remain far behind the developed nations. These trends are skewed to South Asia and the Far East, where we can reasonably expect growth in cyclical sectors. Increased affluence leads to increased consumption of goods. Investors can buy into companies in emerging markets at a discount to developed equity. This is less apparent after a strong year-end and beginning of 2021. However, multiples in the emerging world are lower. Enticing valuations should continue to attract foreign investment, which in turn will feed into economic growth, creating and justifying rising corporate valuations. In the pre-pandemic environment, global growth was increasingly driven by emerging economies. Post-pandemic, these economies may benefit from being first in and first out, and outperformance in GDP growth terms is likely to continue. In spite of the increasing convergence of global equity markets, emerging markets still offer a diversification benefit for those holding developed market equities. The above correlation table shows the 3-year correlation of the MSCI Emerging Markets Index to various developed market equity indices. Significantly for UK investors, correlation with domestic equities, as represented by the FTSE 100, is lowest at 0.60. Investors in emerging markets do expose themselves to specific risks. These include political instability, domestic infrastructure problems, foreign exchange risk, liquidity risk derived from state ownership, and regulatory risk. Investors should also be aware that the relationship between GDP growth and equity returns is not guaranteed, and there are many factors which can decouple the two. We link to an interesting report on this in the further reading section of the show. The index you track is by proxy your fund manager. In developed markets, evidence suggests there is negligible benefit derived from agonizing over which index to track. The FTSE Developed World Index in blue returned a marginal 2.59% premium compared to the MSCI World in red over a 15-year period. However, after tracking errors, timing of capital contributions, spreads and dealing fees, we can reasonably expect any premium to be eliminated. However, in emerging markets, the story is rather different. Over the same 15-year period, the MSCI Emerging Markets Index in purple returned a significant 68.46% premium over FTSE's Emerging Index in pink. A 2017 ETF.com article by Cynthia Murphy compares two large US ETFs, EEM and VWO, which track the MSCI and FTSE's emerging indices, and concludes that the return difference between these two products is not significant. Whilst this is true of the time periods that she examines, as we can see, the performance gulf widens over long holding periods. Given the long-term thesis attached to most investors' allocations to these ETFs, this is odd. In order to understand this difference, it is necessary to look at the methodology of MSCI and FTSE in composing their indices. Indexing is ultimately an arbitrary strategy, and the process of compiling an index is far more active than many casual index investors realize. The composition of MSCI's index differs significantly from the FTSE Emerging Index. MSCI classes South Korea as an emerging market, and it accounts for 13.3% of the allocation, the second largest allocation to a single country in the index. FTSE classes South Korea as a developed market economy, and as such includes it in its developed index. This difference has a great impact as the performance of both indices exposure strategies is sensitive to the performance of the Korean market. In 2020, the Korean market, as represented by the KOPSI, enjoyed strong performance, returning 44.10%, 37.65% of which was from a strong rally from Q4 into year-end. A similar discrepancy has existed with Poland since 2018. However, given the size of the allocation, this will likely be less impactful. In future, it is likely that MSCI and FTSE's differing approaches to the inclusion of Chinese A-shares will prove to be the most influential factor. A-shares are renminbi-denominated shares in domestic Chinese companies. These are traded in Shanghai and Shenzhen. Since 2003, select foreign institutional investors have been able to access these shares through the Qualified Foreign Institutional Investor Scheme. However, the supply of A-shares available to foreign investors has dramatically increased as China has opened up. MSCI began partially including A-shares into their emerging index in 2018, and these make up currently around 5% of the index. FTSE introduced 25% of A-shares into their emerging index, currently accounting for around 5.5% of the FTSE emerging index. For reference, full inclusion would account for around 40% of both indices. It is worth monitoring how both index providers handle the continued inclusion of A-shares, as divergence here would create significantly different exposure profiles. ETF investing in Chinese equities is complex for UK investors and deserves its own report, which we will cover in a subsequent video. The MSCI Emerging Index includes 85% of the investable market, whereas the FTSE Index captures 90%. As a result, a FTSE tracker potentially has more exposure to small caps than an MSCI tracker. Small caps historically have had a greater exposure to return factors. However, small caps are also typically more volatile and can incur greater downside capture. It is worth noting that over fewer holdings, MSCI allocates to more nations in Latin America and Eastern Europe. When we take these two exposure strategies together, it is unlikely that these differences will drive significant out or underperformance in the short to medium term. However, depending on your current regional and factor allocations and outlook for emerging markets, it is worth considering which might be more suitable for you. When considering portfolio construction, the inclusion or exclusion of South Korea has proved to be the most contentious in the past. It is argued by some that mixing index providers in a portfolio should be avoided. This is certainly true in a two-fund equity portfolio, or an investor may be allocating to a broad market developed tracker and a broad market emerging tracker. Carelessness in construction could lead to double exposure to South Korea or none. However, in a more complex portfolio with various regional and factor funds, such a simplistic rule does not work. Examining your existing developed market and emerging market exposure holistically, and then deciding whether to track FTSE or MSCI indices is likely a more valuable experience. Monitoring the ongoing inclusion of A-shares in respect of your existing allocation to onshore Chinese equity is likely to have a greater influence on your index of choice in future. And now for our top picks. In deciding which ETF to go for, it's important to look at a range of factors, including benchmarking cost, the fund size, the geographic and sector exposure, the number of holdings, their concentration, and rebalancing frequency. You may notice that of all the physically replicated picks, we plump for an optimized sampling strategy rather than full physical replication. Given the relative illiquidity of certain companies in each index, we believe that this results in lower costs incurred and better outcomes for most investors. 1. The iShares Core MSCI Emerging Markets ETF, ticker symbol EIMI. EIMI is the largest emerging markets ETF on the London Stock Exchange. The fund is large, liquid, and incurs minimal tracking error. It is fairly cheap at 0.18%, and it is our favourite physically replicated means to track the MSCI Emerging Markets Index with an accumulating ETF. The fund currency is US dollars, so UK investors are taking a foreign currency risk here. If you are looking for a comparable distributing ETF, ticker symbol HMEF, the HSBC MSCI Emerging Markets ETF is a sufficiently large and liquid distributing ETF. It is marginally cheaper at 0.15%, but UK investors are still subject to the same foreign currency risk here. 3. The Vanguard FTSE Emerging Markets ETF, ticker symbol VFEM. VFEM, or VFEM, is the only means to track the FTSE Emerging Markets Index on the London Stock Exchange. It is large and liquid. Accumulating units trade under the ticker symbol VFEG. However, the fund is far smaller at 74 million. 4. The Amundi Emerging Markets ETF, ticker symbol AUEM. For investors wanting a cost-effective synthetic solution, AUEM is a good choice. The instruments held trade in Europe and Japan, so can be traded during European and Asian hours. This reduces the liquidity risk which may be incurred through a physically replicated strategy. Synthetic ETFs offer tax advantages also. This is a big topic and something that we will be addressing in a future video. 5. The iShares MSCI SRI Emerging Markets ETF, ticker symbol SUSM. SUSM provides access to a socially responsible, screened EM index with reduced exposure to fossil fuels. This alters the composition of the index considerably, reducing the exposure to China and South Korea and increasing allocations to Taiwanese and South African companies. This is further clear when we look at the top 5 holdings of SUSM. SUSM implements a rule that no single company should exceed 5% of the index composition. There are also notable differences in the sector exposure of SUSM compared to an MSCI Emerging Index tracker. In the period since the Q1 sell-off in 2020, the SRI index in pink has outperformed the EM index purple by 18.7%. However, from March 2016 to March 2020, it lagged the parent index, and this is the risk that investors take here. This scatter plot looks at the 3-year risk and return characteristics of various ETFs. SWDA is a popular MSCI World tracker from iShares. SUSM, point D, incurs greater volatility than HMEF, point C, and VFEM, point E. But investors are not adequately compensated for this greater volatility. SUSM underperforms HMEF by 0.1% over the 3-year period. SUSM only marginally outperforms VFEM by 0.9% in the same 3-year period. 6. The iShares MSCI Far East ex-Japan ETF, ticker symbol IFFF. An alternative to investing in a broad emerging market ETF is to target your allocation to the Far East. This would suit investors with a high conviction outlook on the Chinese growth story. IFFF is a good pick, incurring minimal tracking error, providing targeted exposure to the Far East. As a regional fund, it is more expensive than broader EM trackers. If you are seeking accumulating units, HMAD is your alternative. It's slightly cheaper at 0.45%, but the fund size is smaller. Nevertheless, it's unlikely that this will be shuttered at over $600 million in assets under management. Not all of these ETFs will be available to purchase on all platforms. At the date of recording, the 8th of February 2021, availability is as on screen. Thank you for watching. We hope you enjoyed yourself and found the information contained useful. If you did, please like and subscribe. All information and more is available in the show notes. To access these, just follow the link in the description where you can download the PDF. The show notes are free to download, however it is possible to make a donation when you download, and any amount would be greatly appreciated. Otherwise, please don't worry. Thank you and good luck investing.